Hey folks, welcome. We're just waiting for Jake to join us, and Sean will be joining us in a little bit as well. Thanks for coming in. Hey Jake, how you doing?
Hey Jeremy, how are you?
I'm really good. How are you?
I'm good as well. Thanks for setting this up.
Yeah, absolutely. So just for everyone here, this is part of the Money Movement Club on Clubhouse, and Money Movement is sort of moving from being a video podcast to being something that we really try and do here as a club on Clubhouse. And great to have a lot of awesome people in here, and we're doing this sort of talk show format, and really excited to have another conversation with you, Jake. Obviously, the sort of meta theme here is this financialization of NFTs, and I think we're going to talk more broadly also with Sean, who's Circle co-founder, who's going to join here in a little bit. But just I think these bigger themes of kind of monetization that are happening with NFTs. It's essentially a very significant radical new form of monetization for content and items and other things on the internet, and so we want to kind of touch on the interaction across all of those. But first, Jake, you actually got me excited about doing this episode and having this conversation with something that you recently published. There were obviously some great tweets, but sort of sitting behind it, you wrote something that really had to do with really discovering price discovery, and NFTs are this new category of value, and there's so many different ways that people are trying to figure out, how do you establish value on these? Is it this purely speculative medium? How do we think about this more broadly? If NFTs, scale out to be, millions or even hundreds of millions or billions of NFTs, how do you create price discovery and efficiency around that? There's so many different dimensions of this that we want to talk about. But maybe just to kick things off, Jake, just for everyone's benefit here, just talk a little bit about the high level kind of concepts that you have around financialization of NFTs, and if people need some fundamental definitions, we can get into those as well.
Awesome, thanks, Jeremy. And just wanted to say that the last Clubhouse you ran with me on NFTs, that was super insightful and great questions. So I'm super happy to be back here with you on this topic, which is now going a little bit, maybe one layer deeper, into this whole thing. So the high level is that the thesis that I kind of put forward is that, I think we should design NFTs as basically property rights to digital content. That's, if you read the first piece, which is all digital content is going on chain, that's what it's basically saying. And there is a little bit of a disconnect kind of with what is actually out there in the market in terms of implementation and that view, right? Because we haven't worked in, terms of service into NFT issuance yet, but it will happen. And actually I'm talking with a number of groups who are interested in marrying the legal side and the token side, and there's a lot of precedent in blockchain. Anyway, we could go on and on about that, but the high level is the thesis is that NFTs are a new financial asset class. Last time we spoke about the fact that is very exciting because that particular asset, that particular set of assets like IP that exists in the real world has historically and traditionally been quite illiquid. And in turning them into digital assets like NFTs, we're actually kind of taking them public in a way, right? And that is a big event. So that was
you use this phrase "liquid intellectual property," which I love, right? Which is intellectual property means so many things in this world, obviously, and obviously. A lot of people may or may not remember Esther Dyson's, seminal work in the early days of the internet, where, she the mantra was information wants to be free. And I think a lot of the ethos of the internet, really from that point, and it leads to open publishing platforms, even one might even say net neutrality and broader concepts for this sort of open medium are anchored in historically the idea that information wants to be free, and the internet fundamentally wants information to be free, and everything should just be out in the public domain. And I think for many people, they've struggled with that and what that means. If intellectual property essentially, does that destroy intellectual property is the other side of that, and what does it mean to have intellectual property on the internet? And we actually haven't had a way to, in a systemic way, have intellectual property on the internet. At least, we have open source, right, which is a very, very specific form of intellectual property, and Creative Commons, and these all reflect this ethos of information wants to be free. But now we're seeing that the creative people, and that spans so many things, right, are realizing actually my creative work has value. How can I actually marry that value to the internet in a new way? And so this idea of liquid IP, I think, is really, really powerful. Just to maybe connect the dots to that earlier conversation we had, and some of the writing you've already done, just for everyone who's kind of in attendance here, just reminder, the kinds of things that are going to become NFTs that we kind of don't imagine as intellectual property that can be liquid on the internet today. Just maybe rattle off I think you had a tweet storm with like 30 things, but whatever, it would be interesting for people to hear.
Right. Yeah. So just to recap a little bit, and thanks, Jeremy. We predominantly think about NFTs as digital art, collectibles, and in-game assets today. We're starting to see a little bit of music being issued as NFTs. We're starting to see some like generative art and like algorithms, and a little bit of writing that's mirror. But if you think about kind of the long tail of digital content that could be tokenized, it's really very, very long. It includes stock photos. It includes 3D models. It includes metaverse assets. It includes plugins into Photoshop, domain names, and we could probably go on and on and on. And we didn't even mention, kind of streaming video and audio and like the usual things that kind of live on centralized platforms today. Art is a $2 to $3 trillion market today. God knows how big it's going to be after it's tokenized. But if you sum up the long tail of, the less or the more boring assets, let's say like fonts, icons, right? All of that stuff, design assets. I think altogether those things on decentralized marketplaces is a bigger market than art.
Yeah, absolutely. I mean, and I think, we have, essentially, moments, right? We, things like Top Shot are demonstrating like you're able to take, the expression of something that's amazing that happens in the world and turn that into liquid IP, which is when you think about the amount of content that gets created of that type associated with things that people have an emotional value attached to or would be interested in possessing in some way. It's pretty mind blowing. So I mean, maybe it's billions of entities over time easily.
Yep. And so I guess to take it a step further, so if we accept that thesis that we're dealing with a new financial asset class, then if we step back for a second and look at digital assets in blockchain, we basically have this bifurcation into fungibles and non-fungibles. And historically, fungibles are very liquid, and the criticism of non-fungibles has been that they are very illiquid. So to challenge that first assumption a little bit, I mean, if you go back 3 or 4 years, it was actually quite challenging to get a token to be liquid. For most founders, that looked like getting listed on a centralized exchange. That process, usually spanned months and sometimes years. It sometimes involved multi-million-dollar payments to exchanges that wanted that kind of compensation for listing, especially at times like 2017 ICO boom. And in fact, liquidity wasn't that easy to obtain for tokens. Now, what ended up happening is that the market recognized this and created decentralized exchanges. And decentralized exchanges today serve $2 billion of daily volume, and together with liquidity mining programs, they have brought down the time to liquidity of an ERC20 token to basically zero, to basically a day or a week or something like that. And so what we're, in that progress, we're seeing essentially mechanism design being applied to the liquidity problem for fungibles. And the really funny thing about that market is that at $2 billion a day, we're still less than 1.5% of general crypto daily volume.
Right. Yeah, I mean, it's tiny.
It's tiny, and yet it's serving the entire long tail of of the DeFi tokens and of the really decentralized stuff and the esoteric stuff. And it's poised to take a much bigger chunk of that market. Now, when we go to the non-fungibles asset class, then the criticism has been, well, these are very illiquid assets. They're dangerous. These marketplaces that they're on aren't really doing a good job with liquidity. And sort of what my second article goes into, in that article that you pointed out, Jeremy, that's called Appraisal Games and the NFT Liquidity Problem. It's just pointing out that for non-fungibles, it is merely a mechanism design problem as well to solve the liquidity problem. It's just that it requires different mechanisms than fungibles.
Right.
And yeah, so let me pause there. Does that make sense?
No, it totally makes sense. I want to, just for people here, kind of trace this through to, a real world example of, obviously the classes of NFTs that people are focused on today are things like crypto art. Obviously there's sort of, other forms of native, digital content. There's these greater creative expressions, there's moments, there's in-game items, right? But, maybe just talk about what's the problem that, someone who has, is trying to accomplish, someone who wants to buy one of these and is trying to figure out, what should I pay for it? And then someone who has one and potentially says, I think this is really valuable, and is there a way for me to generate other financial value from the asset that I hold, which is what people do with, stocks that they own or houses that they own or other, stocks and houses are non-fungible tokens too. So they're non-fungibles in terms of what in fact they are. And, just connect to, a couple of real world examples here that I think, people can connect to.
Yeah, well, I think a really disruptive example, and as you pointed out, there's two sides of this, right? There's the supply side. I'm the creator. I'm creating NFTs. And there's sort of the demand side. I'm the buyer of NFTs, the investor, the collector, whatever it may be. I think the really disruptive use case is when you can say, listen, a creator has created a work of art, and they can deposit this work of art into a smart contract. And really, without a counterparty, they can withdraw liquidity. That's...
It's incredibly powerful, right?
That is incredibly powerful. It's disruptive. It's not just powerful, it's disruptive, right? Because we often think of art in a traditional sense being very expensive. And this will surely bring down some of the price points of art. So on the one hand, it creates this mechanism.
Just welcoming Sean. Hey, welcome.
Yep. So on the one hand, it creates, this completely incredible ability to turn creative content into cash. And on the other hand, it brings down the price point of that, of those assets over time.
Right.
On the demand side, you mentioned, maybe we want just to understand pricing better, right? Like we want to know as investors, like how much should we pay for NFTs? And also we want exposure in ways that are hard to get today, right? So today, if I get this question 7 times a day from folks looking at the NFT space, like how do we participate? And as an investor, it's quite hard to go NFT by NFT and try to predict what's going to be big later, and who's a talented artist, and what's going to sell later, what's going to be a big brand. And really, what investors probably want are some kind of index fund exposure vehicles. That's now becoming possible with things like fractionalization, with funds on chain that hold NFTs and things like that. And so we're not creating vehicles where investors can easily invest into the space, and the space can benefit from that capital. So that's another really important aspect of the financialization of this.
Yeah, so there's a lot of pieces here. There's price discovery, there's fractionalization, there's the ability to essentially borrow against assets that I have. So a lot of those there. I want to welcome Sean into the conversation, and I know Sean is going to bring, I think, a really different lens here. Sean, as many of you know, is co-founder of Circle, and we've been talking a lot about NFTs lately. And I think the theme maybe I could have you comment on, Sean, is the really this concept of this new model of monetization for creators and creatives, and what does that look like for creators and creatives, and then I think we'll connect the dots here, because that they are ultimately related, because you are creating these markets for creativity that are quite different. But maybe just kind of ladder it over to you here, Sean, and hear some of your high level thoughts. You're muted. Hello? All right. I'll text Sean and see if he can unmute. All right. Well, we'll come back in a second on that, and come back to you, Jake. So maybe we could take some of those actual use cases. Oh, there you are, Sean. Yeah, that's right.
Yeah, too many microphones running at the same time. Sorry about that.
Yeah, no problem. Did you hear my kind of?
Yeah, I did. There? Yeah, sure. And I heard the tail. Sorry, I came in a little late here. I heard the tail end of what Jake was saying. I think it's worth returning to how you look at this as an investor as well, because it's increasingly tricky, and there are obviously emerging tools and mechanisms that are pretty interesting, but it's a lot to make sense of. But on the creator side of things, that's an area that I've been looking at pretty closely, and I guess represents a little bit of a personal light bulb moment for me that I had a few months ago on this, which is related to this concept of actually owning a piece of digital content, as opposed to subscribing to or following or somehow acquiring access to a gateway into the content. So, it's not a ticket to view an experience. It's not a subscription to access written content or to stream it. It's the ability to own a digital thing, and that concept of ownership, and then also secondarily provenance and the history or quote unquote legitimacy of a piece of content is just something that has not been possible before with any kind of digital goods. And I think it obviously changes things for creators, as there are obviously a ton of high profile experiments in that space right now that are happening. But I think it really transforms things for content creators who are also consumers of other kinds of content. And that's, fans, it's followers, it's audiences. But my particular area of interest is audiences that consist of other content creators, whether they're, streamers, gamers, digital artists, musicians, whatever. And the kind of convergence of ownership with finance, and how all these things sort of fit together. So that's sort of the area that I've been thinking of, and there's lots of examples. The difficult thing about talking about content is, and trying to explain it to others, a lot of the examples can seem a little bit trivial. And the underlying sort of expression of the origination and the ownership is powerful, but doesn't necessarily resonate with just everyone. I can give a simple example, like I can walk into a museum and take a picture of the Mona Lisa, and I can digitally distribute that anywhere online. I can put it anywhere I want. I can hang it in my house, but everyone knows I don't actually own the Mona Lisa. I can't legitimately sell it unless I'm particularly clever. I can't really sell it. But not everybody would want to have that sense of ownership in the first place, so it doesn't necessarily resonate with them. But for those who do place value in the concept of ownership and the things you can do with ownership, and pulling things into collateral, but also participating in upside, sort of future revenue streams attached to ownership and provenance, is just something that is just new in this space.
Yeah, no, totally. And, I guess like when we talk about financialization, there's sort of this is like, fundamentally a new way to monetize creativity, which is powerful. I think, you can imagine, and this Jake was talking about this at the start, which is, people who, have tried to create liquidity for fungibles, that historically had a problem. And now, obviously, decentralized exchange and liquidity pools and automated market makers and other things are making that easier to bootstrap liquidity on things. But with NFTs, you can imagine a world where, effectively, people are issuing, fungible tokens to finance the creation of non-fungible tokens. And then, sort of like, Kickstarter, right? And then you get the non-fungible token. It's like a pre-order, and then, you're then, participating in ownership, but then there's obviously down the line, the other forms of financialization that can happen once it exists as property, in this digital realm. So it's a lot of interesting connection points there. Jake, maybe just to connect back to you on kind of taking some of those simple examples and then maybe bringing them to life.
Right.
Go ahead.
Right. So maybe just to go back to the thesis of the article, which really deals with, if NFTs are a new financial asset class, then we're going to need sort of financial primitives and services for that asset class. And what does that look like? What does that start with? And I think what that starts with is this like problem of liquidity. And then that problem has seemed historically very hard. And I guess the main question that the piece tries to address is, well, how do we solve that problem? What are the actual mechanisms available to create an NFT liquidity? And we see a few mechanisms in the market today, right? So like the basic way of creating a pricing for an NFT is to sell it on the marketplace, like OpenSea or Rarible or something similar. And that's great. But what we see is that if you restrict yourself to only pricing NFTs this way, it's hard. You need like a really big critical mass of buyers and sellers that historically hasn't been there. You don't get like a ton of sales. They're going up, but there's like a long tail of assets that never sold. And so you don't know what their prices might be. The other way is auctions. And as a matter of fact, if you look at the on-chain data, you will find that something like 80 to 90% of people who transact on kind of the existing marketplaces like Super Air today will prefer the auction format. Auctions are probably preferred by creators because they tend to be exuberant. They maximize the return that the creators make. And they also end up creating a price. So, what makes a great mechanism for creating liquidity? And I argue that what makes a great mechanism is capital efficiency. What does that mean? Well, if I'm selling an NFT worth $1 million and someone buys that NFT for $1 million, that kind of means that like for every dollar of valuation that we created, $1 had to change hands. And if you bring that into the auction context, it means like for every dollar of valuation that is created, one or more people bid on that, right? And so potentially more than $1 had to change hands and even be locked into the auction mechanism for a while in order to create that valuation. And so the question is, do we have mechanisms that are more efficient than that, where I can price something at $1 million, but in doing so, I don't spend $1 million. I maybe spend $100. And the answer is yes. There's a bunch of different mechanisms. Kind of the most obvious one is we'll create a machine learning algorithm that goes around and machine learns all of the traits of CryptoKitties and all of the properties of CryptoPunks, and then compares that to how they sold on the market, and then creates a model that can automatically price these collectibles. And then the cost of that mechanism is the cost of creating and maintaining the model, which is really kind of a fixed cost. And then the valuations that it can create are infinite. And so the efficiency goes up. The capital efficiency goes up over time, gets amortized over that cost. And that's a great approach. And I think a few people are doing that in the space. And the problem with that approach is it seems like it would probably work quite well for really objectively valued things like collectibles, but it would probably not work that well for really subjectively valued things like art. And so there's another mechanism, which is fractionalization. This is also an example of a mechanism that can value something at $100 million, but only a few dollars need to change hands in order to create that valuation. And that's because the NFT becomes sharded into a number of tokens, and only a few tokens have to change hands to imply a valuation. And so fractionalization is a really capital efficient mechanism for pricing NFTs, but it's also really heavy machinery. If you think about all the objects that we have sort of counted as belonging to the NFT asset class, we're talking about trillions of objects. And some of those objects cost $5. And it's probably not that capital efficient at the end of the day to create a token supply for every one of those trillion objects and a whole community around it. And fractionalization also comes with a bunch of complexity in terms of sort of mutual ownership of the things. So, for example, no one really talks about what happens if you take 51% of the tokens of the fractionalized asset, and burn them. Does that mean that the asset is now worth zero because you can't move it and you can't vote on it anymore? No one talks about how to unfractionalize a fractionalized asset. It seems to be sort of like a one-way street unless you take extraordinary efforts to design, the governance system to undo that. And you still have an edge condition where maybe you won't be able to. And so when I think about fractionalization, I think about that makes sense in a context where, like CryptoPunks, right, where the assets are really valuable, and it makes a ton of sense for 20,000 people to own them at the same time. But that mechanism doesn't work well for things that are $5 in the long term. Does that make sense?
Yeah, no, it does. And I think, for a lot of folks, some of this is sort of feels like, there's just these intensely, sort of speculative markets for, icon creators, and, how do you game that and how do you price that? And, it's sort of this intense speculation kind of thing. And when people think of derivatives and now we're going to have derivatives for price discovery on icon creation. Like, I think for a lot of people, they have a hard time sort of relating to that. And so part of me, what I'm interested in drawing out here, and I love Sean's take on this as well, is like, how do we get out of the like, oh yeah, there's like all these like, really cool like icon things and crypto art things, and really, stepping back and saying, what are going to be NFTs? What are going to be mainstream NFTs that the average person is going to have that are going to be in the world in a year or 2 years, and then how these fundamental financial mechanisms are going to improve the process of discovering, finding, owning, and participating in those markets. And because I think for a lot of folks, I think they sort of struggle with like, okay, I hear what you're saying about machine learning on CryptoPunks, icons, but that isn't very relatable to what this looks like at scale when we are talking about the number of digital content objects that might move into this kind of realm.
Yeah, for sure. And so, well, that kind of brings me to sort of the next mechanism that I talk about, which is creating pricing through oracles. And in particular, I talk about Upshot. I think I saw Nick Emmons, who is the CEO of Upshot, in the room. So, hey, Nick, if you're there. But the idea is that Upshot is a really interesting protocol, which is an on-chain question-answer protocol, which incentivizes the people who answer the questions to answer questions honestly. Mm-hmm. And the really interesting application of such a protocol in the NFT space is basically asking the protocol, what do you think this NFT is worth? And sort of finding in an on-chain way a kind of like educated consensus around the price. It doesn't have to be the exact prediction of the price. It doesn't have to be the price at which the creator necessarily sells the work, but it is kind of an estimate of what of what the market would value it at, and it's coming from the estimation of essentially experts who are incentivized to do a little bit of work to figure out what that pricing would be. So they might compare like Beeple and another creator and note that Beeple sold work for millions of dollars, and that might impact that final estimate. Now, when we have the on-chain Oracle pricing, I mean, what essentially we can then do is we can tokenize it and sell it now, right? And that basically creates liquidity for the long tail of NFTs. So when I think about capital efficient price discovery mechanisms, I think machine learning, will have a little bit of a place. I think the really high value publicly owned stuff like CryptoPunks will be likely fractionalized into your C20s, and that makes sense. I think the long tail of assets in NFT space that are very cheap and don't warrant a full token supply can be priced through oracles, and those oracles can create essentially some kind of average pricing, right, at which you could always liquidate this portfolio. And then there might be other mechanisms like we've been seeing, essentially bonding curves applied to NFTs. I think Euler Beats was an example of that. There's a few others. And so the advantage of that mechanism is that I think people can the creators can kind of control the rate of appreciation of that curve, of that bonding curve. But it remains to be seen if that's going to be a widely used mechanism. I'm super bullish on fractionalization and oracle pricing kind of for the majority of cases.
Yeah. So, Sean, just asking you as someone who's thinking about this really from the creator's perspective, and and communities of creators, and people who are not focused on trying to design speculative items, but really who are really just focused on monetizing creativity, and what that looks like. How do you think about things like price discovery, fractionalization, and appraisal models, sort of oracleized appraisal models, things like that in relation to, what someone who is really just really trying to do is just find a new model of monetization.
Yeah, I mean, I think the sort of peer prediction oracle model is super interesting, and there can be, multiple variations of that. So I think that's relevant. I mean, from a creator perspective, or even from a sort of creator / consumer investor perspective, my instinct is just that this whole ecosystem is just going to be way too big to make it effective to sort of pick individual assets, at least as a generalist, unless you know something very deeply about a particular community or about a particular creator. And so, pursuing other options is going to be necessary as this grows, because it's just, this whole thing is the internet and this particular technology has just been so effective at taking formerly illiquid assets and then suddenly making them enormously liquid. And Sam Lessin wrote a little bit about this recently. And so, I mean, there's a number of different ways to go in sort of creator, but still some of the most obvious problems are just in how you interact with this. Creators are able to take advantage of platforms like Twitch and others to sort of circumvent the Spotify-like models. They no longer need several million monthly streams, 30 seconds or more. If you're as a musician to make a living, they can have an audience of very loyal followers that number in the hundreds and make a living. They need to churn out an enormous amount of content to do that. But they sort of, cut out a lot of middlemen, and cutting out middlemen just means that the creators end up taking on more of those business functions themselves. It doesn't mean that the business function ceases to exist. So things like packaging, marketing, community interaction, all that sort of falls on the creator. So when it comes to digitizing ownership of experiences, whether that's a limited concert, 100 pieces of ownership of a concert that is, a bootleg concert that can be subsequently traded, or some other kind of, piece of art. The tooling around how that works and how, what that feels like from a creator perspective and from a follower perspective, assembling essentially a portfolio of creative objects that hopefully generate dividends, which is kind of what happens when you're a follower accumulating these experiences. The tools and the experiences and what the products really look like is just, it's not there yet. It's sort of a group of plugins, multiple chain options, different open marketplaces, a few sort of white label branded experiences as well. But there are a lot of great early experiments happening. But from a creator perspective, that tool set that acknowledges I am running a business as a solo creator, and I have a direct interaction with my fans and audience, and I need the tools to make all of that work effectively. That sort of piece isn't there. So whether you do that as investment in NFT infrastructure or just tools and other parts of the ecosystem, that's another sort of area I think that will get fleshed out over these coming months.
Yeah, and there's a huge amount to build. Obviously, on those fronts, I want to maybe just turn this one other direction and get both of your thoughts on this, which is, as we started about at the top here, when most of the time when we're talking about NFTs, we're talking about, as noted, this sort of liquid intellectual property that can exist as digital content items that are on the internet, on blockchains, etc. But obviously, the concept of a non-fungible token extends, well outside of purely digital objects and into physical objects, and also into even access to, say, underlying royalty streams, underlying yield from someone who's producing something, and I'm just curious to hear your thoughts on the crossover between the physical world and NFTs, it very much relates to the financialization of NFTs, because if you can build these really, really robust long-tail capital market functions for NFTs at the digital content item level, you also obviously are really fundamentally building the same underlying market infrastructure for NFTs that have to do with physical objects, as well as even concepts like there's a landowner in a country that wants to sell NFTs that are essentially profits from the yield of the land, as it were, just in a really, really simple example. And that's a form of non-fungible token. And those types of financial assets that also are going to need to participate in long-tail capital markets, that are also going to need to have these various forms of price discovery. And people are going to want to have index allocators and other things to be able to have those as part of their quote unquote portfolio. I would love to hear. I'd love to hear your thoughts on that kind of crossover that's outside of the purely created in a digital form, kinds of NFTs.
Happy to go, or Sean, if you wanna hop in.
No, go for it. I'll hop in a second.
Yeah. Well, thanks, Jeremy. I think you covered it, kind of the high level, which is that you're absolutely right. Like the infrastructure that is being built out for NFTs is kind of an abstract asset, right? Can then very well be applied to real estate, or car ownership, or any number of sort of like physical tokenizations of real world goods. Why are we not seeing that? Well, I just think that the digital side of things is a lower hanging fruit.
Sure.
And it is also a very interestingly compatible sort of space with blockchain, right? Because I always think of digital art as being quite ethereal and never sure where the artwork actually is. Right? Like, is it in your email? Is it on Twitter? All those seem to be reproductions of digital works, but not actually the work itself. And so when you put that on a blockchain, you create, that certificate of authenticity, or even like the localization of that work, in the sense of like, you found it. Okay, it lives on the blockchain. That's the handle to it. I can take that handle and transfer it to someone else, and not own it.
Right. It's a demarcation of property and provenance, and those are like these fundamental things. And if it's entirely digital, in an entirely digital property ownership model, right, that's, as you said, it's low-hanging fruit. It's easier to kind of get to. And it actually ties to a lot of like this billions of different digital content objects that are out there today. And so there's a clear mapping there. Right. But there's one could argue that there's far more digital content items than physical things in the world,
right?
But there's an awful lot of physical things in the world that people value.
I was just saying on the morning meeting at CoinFund this morning, I'm like, everyone is kind of obsessed with NFTs right now and DeFi, but if you want to start the contrarian crypto fund of this particular moment, you should start the security token real estate crypto fund, right? Mm-hmm. Because that's the thing that like nobody's thinking about that's coming next, which is essentially the tokenization and NFTization of physical goods.
Well, and obviously equity itself, right? Equity, people could say, well, there's this sort of fungible tokens, and then there's sort of fungible tokens that are scarce, that are out there, governance tokens, et cetera. But like equity is a form of non-fungible token. You have X thousand shares or X million shares, and they represent a profit sharing contract, in the form of dividends and voting and the like. And, that is just a financialization of the work output of a collection of labor. And so, the interesting question for me is, when do we start seeing more NFTs that are equity-like, that are not themselves equity. They're not actually, there's not like a Delaware LLC necessarily, although with open law and things like that, you're seeing this kind of mapping that's there. But, NFTs as things that people can own and participate in, just like you'd say, like a fractionalized piece of crypto art is something that you can have ownership in, and it may grow in value. It doesn't quite produce cash flows, but it's sort of property and equity are both really big forms of NFTs. I mean, basically, they're, if you count up the equity in the world and count up the property in the world and the financialization of property, right? I don't know how many gazillions of trillions of dollars that is, but it's a lot.
Totally agree.
Yeah, I mean, I don't want to necessarily go to the extent that we can see absolutely everything as an NFT. But if you want to do it as a thought exercise, when it comes to things like real world items, where there's some barriers, whether geophysical or regulatory or whatever, to actual transfer of the item. The way that I sort of thought of it in the past is related to NFTs is kind of another version of storage. I mean, you have an NFT. There's some metadata references to media or other items that are sitting in the AWS S3 bucket, or they're in IPFS, or they're stored not necessarily on a chain. They're sort of stored elsewhere. The physical thing is like its storage bucket is some plot on Earth, and
right.
it's sort of like there's a storage issue there. The question around equity, though, is a tricky one. I know you and I have said a few times that it would be cool if, when we started Circle, we could have just figured out how to have it been a fully tokenized autonomous organization back in 2013. That was not. It was really not a thing that was possible. So I understand, where you're going with that. From me, I like the idea of not stepping into all the regulatory hassle of securities and sticking with content, because there hasn't been enough solved in that area yet for me.
No, for sure. I mean, content is the lifeblood of the internet in many ways. It's, I mean, lots of other things too, but inverting the monetization model on that and creating financialization of that are profound, and those are also like these multi-$100 billion huge opportunities that actually we're opening up new outlets there. We have a little bit of time here, and so I thought I'd invite people to ask questions. And so anyone who has a question, you can raise your hand, and we'll try and get you through. But Angie, thanks for joining us. We'd love to hear your question.
Yeah, thank you so much. So it's so funny. I had a call today with so I come at this, the NFT market from a video game perspective. And I've been really excited about NFTs basically since they started. And I had a real estate investor today call me and ask, why hasn't this taken off? Like, we all read those articles in the New York Times about how downtown properties were going to be fractionalized and sold and traded for Brooklyn, and what you said, Jake, makes so much sense. And I just don't know the answer to that. I mean, there's a game called Upland that I've been playing where you can actually buy properties in New York City or all over the country. And some of these buildings are trading at like $200,000, $100,000 in the game, but we haven't seen it in real life. And I just don't know if we're just not there yet, but I love all your thoughts.
Well, we can all probably blame Jay Clayton for that not actually happening, and hopefully a more creative, inspired, and technically competent head of the SEC will lead the way here. But I think we didn't even have a legal basis at the SEC to do this kind of stuff until the end of December of last year. So I think there actually now is a legal basis for people who are involved in securities, in a sense, to have fully digital renditions that can be on blockchains. The SEC cleared that, to some degree. And so I'm actually cautiously optimistic that this year we're going to start seeing a lot more activity there, and that will grow over time. There certainly are regulators in other markets that have been more progressive, but certainly here in the United States, there was basically a giant block on anything under the supervision of Jay Clayton. That's just my quick take on that.
Hey, Angie, great to see you. Thanks for your question. And yeah, I totally agree, Jeremy. I think part of it is just the kind of regulatory compliance piece. But I would say also the following. I'm super excited about the real estate use case, and I'm not particularly biased whether it happens through security tokens or some other mechanism. But I'll tell you this: I sat down at a platform which tokenized REITs like last year. And realized that as a crypto investor, I'm totally unequipped to evaluate a REIT investment. And
right.
A REIT investor is totally unequipped to evaluate whether the blockchain technology that the offering is on is good or trustworthy. And so I do see that there's a bit of like product market mismatch going on there too. And it sort of depends on what use cases, you want to put the technology toward.
I was just going to say these guys were very successful REIT investors. So that's so funny because they had no idea kind of some of the things that I was talking about with respect to art and gaming non-fungible tokens. But they could definitely see it in, sorry, I have a puppy here. They could definitely see it in REITs. So that's really interesting.
Yeah, it is. Pine, I hope I have your pronunciation right. Welcome, and would love to hear your question too.
Yeah, thanks for this discussion. I'm coming from a really remedial place, so let me just ask you kind of like a basic question. Let's say I created a piece of, like a photo that that's used a lot and everything. And how do I generate the NFT out of it? Do I bring it into a marketplace, and then there's a whole bunch of people buying just a little piece of it? Or is it just one person that owns it, and could they make money off of it once they own it? Or how is it different than a copyright? I'm still trying to get my head around exactly what we're doing.
Yeah, Sean or Jake, do you guys want to take a crack at that?
Totally. Or go ahead, Sean.
Go ahead. I'm probably going to say exactly the same thing.
Well, I would say to create the NFT, you probably want to head over to some kind of platform that issues NFTs. There's a few of them that are open to anyone and everyone. The one that I'm partial to is Rarible.com. That's our investment at CoinFund. I'm super excited about what they're doing. And then to fractionalize such an NFT once you have it, you can use something like niftex.com or, in some cases you can use nftx.org, which is like funds for classes of such collectibles. And there might be other tools that are functionally similar to those I said.
Yeah, I mean, just looking at this, as it is today, right? You have these are sort of early examples. I remember back in the early days of the internet, right? The number of kind of e-commerce marketplaces. If you had a product you wanted to sell, right? Obviously, things like eBay, took off, and then Amazon Marketplace and others. But there are tons of those, and we're like, we're in the 1996, 1997 of these NFT marketplaces, but I think it obviously there's billions of people on the internet now, and this is technology that is really valuable. I think it will grow quite fast.
How is this different than a copyright?
So if your platform that you're tokenizing on supports, and most of them today do not, just to be clear. But I imagine, like in short order, we'll be supporting kind of the idea that as a creator, you sort of choose which property rights you confer to the buyer, and so that might look like a TOS or terms of service at time of tokenization. But today, you kind of like I would say like probably default copyright laws apply.
Yeah, there's some services that they're experimenting with. Splitting up, say, in music sync rights, again, other kinds of licensing, songwriter rights. How do you sort of deal with all that? But for the most part, it's pretty rudimentary. And I think, like Jeremy and Jake said, the marketplace experiences are also pretty nascent. I mean, things like OpenSea, and they sort of look like almost like an early eBay, although some are a little more specialized. there's the valuable stuff, which is doing the Genesis tweets that have been getting a lot of attention lately. So some of the marketplaces are, I guess, a little more specialized, but for the most part, it looks pretty nascent. If you go to things like OpenSea.io or Mintbase or something like that, there's a whole bunch of them. I'm not recommending one over the other, but there are a bunch out there, and you can kind of see how you might mint some of your own content, and they all have slightly different treatment of things like rights, but they're ultimately pretty rudimentary, and then ways of getting them into a marketplace. So, I mean, the easiest thing to do is actually just to kind of go do it and experiment with it, and not necessarily go into it as an investor or thinking that you're going to generate a lot of money, but just as an experiment to see how it works. I'd say overall for most content creators and consumers, which are by and large the same people in some of these audiences, it's a pretty awful experience, because it's so early. But obviously that presents pretty exciting opportunities. And then there's also the gaming side, which is, I would say, a little bit more mature because of the history of how this stuff came together.
Yeah. Just to open it up to Sardor, thanks for joining. We'd love to hear what your question is or your thoughts.
Yeah, thank you, Jeremy and Jake. Real great conversations. I wanted to just talk about the real estate applications of it. Jake, you mentioned that. Well, let's just preface this with, assuming all regulations will eventually be solved about this, what do you see as some of the features in DeFi, like, for example, liquidity mining or the applications of some bonding curves to entice early adopters? What if that is applied to, for example, real estate projects, like a neighborhood development project where a specific asset is being built on a corner, and the local stakeholders that live around their neighbors are able to all kind of commit their liquidity, provide their liquidity towards this project, right? And then it gets built. And as they're providing the liquidity, all those same stakeholders are earning equity tokens or governance tokens in the neighborhood development fund, so to speak. We have a property down in downtown Memphis. I've been in this for just 3-4 years. So I've been trying to talk to some attorneys here in Memphis, and they're all looking at us like we're crazy. But I know this is possible, at least from a technical perspective. But Realty is doing some amazing things just from a fractionalization of equity, and I just see so much being built on top of that in the real world. Just basically applying the DeFi locally, so like local DeFi.
It's there's a lot of possibility there, and I think as we were kind of talking about earlier, I mean, I think up until really recently, the sort of the kind of legal questions of how do you take something that is what would be considered a security in the United States and tokenize it and offer it on these infrastructures, that's been really difficult to do for a host of reasons. But I feel like things are starting to open up, and then a lot of what is happening with NFTs and DeFi can start to get applied to that kind of property. But I don't know if Jake or Sean, you have other thoughts on this.
I think you guys covered it quite well, and that's a brilliant use case. Once the sort of rails get figured out and the regulatory gets figured out, I see the primary applications as being like, better crowdfunding and co-ownership of real estate, which is really exciting. But also like a ton of efficiency in terms of, buying and selling your house, and also building a portfolio of real estate, like, go long Manhattan and short Brooklyn. Like a lot of those things will be much easier using digital assets.
Yeah, so cautiously optimistic that we're going to see some of those things, opening up. I know we've seen sort of digital securities projects start to really get on the radar at Circle, and people are using stable coins with digital securities, and I think we're seeing more of those come down the pipe. So cautiously optimistic. Archon, thanks for joining. Would love to hear your thoughts or question.
Hi, this is Lord Vader, creator of the Sith Empire. I would like to ask this question anonymously. Do you think characters like me, with a voice like mine and a face like mine, will...
verifying proof of provenance and origination, and there's a lot of fakes, a lot of copies and things that are out there in the marketplace. And it kind of stretches to the previous conversation, which is if you have a technical system that's capable of enforcing logic among parties that don't trust each other in the form of smart contracts or so-called smart contracts, then how long will it take before courts recognize those same contracts as opposed to just contracts written in English? I mean, that's still kind of one of the fundamental problems that we need solved.
Yeah.
Thank you, Sean, Jeremy, and Jake.
You're very welcome. Thanks for coming up. Sasha.
Hi. I have kind of a low-level practical question. So I think one of you, I can't remember which one it was, talked about comparing NFT ownership to sort of what we do now, where we get a subscription to a platform to have access to content. But I'm wondering, what does it actually look like, the NFT scenario? Are we talking about some front end that you can only access if you're a partial owner of some NFT? What does this look like practically? Let's say an NFT for a song or something.
Sean, do you want to take that?
Yeah, I mean, I think there can be a lot of different product experiences that are created around it. Some of the early experiments that I've seen have been almost kind of like a Patreon-like model where, Patreon today, I can follow artists, musicians, whoever that I care about, and with some subscription fee, I can get access to additional content. And so the early experiments I've seen have kind of been along those lines, where instead of a UI that allows me to pay a subscription fee, there's a UI that grants me access to content data based on my ownership of the NFTs, of the actual content that shows that I'm actually NFTs that show I'm an owner of this content. Other experiments are essentially like placeholders for future content, so that I buy a piece of a concert that hasn't occurred yet, but I put my money in to be one of the 10,000 people who are able to access this live stream concert or something, or album release or whatever it is. So it's sort of a placeholder for future content that I'm able to access before others are. So those are some of the experiments around this, but what the product experience looks like for us as a consumer, does it look like a Twitch or a TikTok or a YouTube or Patreon, and what does it look like as a content creator, and how does it tie into the fact that I as a content creator need to run a business? I have Square. What does it sort of look like from a tooling perspective, and then the underlying infrastructure between those two things? Where things really persisted? How does this cross chains? All this sort of infrastructure stuff that I, as a creator or as a consumer, don't really want to have to think about, that needs to function. We need those things addressed as well, and that piece of the experience is addressed as well.
Yeah, and just to emphasize too, I mean, I think part of the fundamental concept of NFTs is the portability and the interoperability, and that's the foundational concept that the blockchain, gives us, and the internet. I mean, but ultimately, if these are just like siloed and stuck inside of private walled gardens, you're not really doing anything to actually create ownership. The ownership does need to persist, and it needs to persist outside of where you may have acquired it, and so there's tremendous opportunities for innovation in the consumer layer, at the infrastructure layer. When we think about what banking of the future looks like, banking of the future, whether it be for companies or consumers, right? How you store your digital your digital objects. which have value in the same way that other forms of property have value, and securely do that and not worry about it. Those are lots of problems that still need to be solved, and ultimately, if we can't have that portability so that these things can exist and be priced in markets outside of just the place you got it, we're kind of missing the boat. But it's a great question. Maybe the last question, we'll turn it over to Jim. Thanks for joining us, and thanks for the question, Sasa.
Hey, thanks, guys. It's a great conversation. I was talking earlier to Zach Burks, the founder of Mintable. And one of the things we're talking about is with NFTs, someone who also was in the discussion was saying if you tokenize an NFT and create fractional shares, you're getting into securities laws, and that by definition made it a security. I guess I didn't think that was necessarily true, and I was going to use the example you guys were about, short Brooklyn, long Manhattan type of thing. If I were to convert the Empire State Building, let's say, into a fractional share ownership, to me that's a security, and it requires kind of central control and future monitoring and things. But if I take my LeBron NBA Top Shots card and I were to fractionalize that to 100 things, and 100 people just happen to own it, but there's nobody who has to do anything, to me that would not necessarily be a security. I don't know if you guys had a view on that. And then also about just NFTs in general, it seems like everybody's just dumping a bunch of crap into a label that says NFT. Someone asked me earlier about taking a music portfolio and making NFT, and I said, look, if it's on iTunes, it's good the way it is now. Like, just stamping NFT doesn't mean anything. I was wondering if you guys had a view on what constitutes value in an NFT. Like Jack Dorsey on Twitter saying, hey, here's my Twitter for $2.5 million, but that to me is a moment in time. There's value to that versus, just taking a music portfolio that already exists and calling it an NFT.
Yeah, this kind of gets to, so some of the fundamental thesis that Jake, sort of was writing about and starts with, which is how do you establish value, and how do you achieve price discovery, and because there are going to be this incredible long tail of people providing these, and obviously the current price discovery mechanisms and the marketplaces and everything else, leave a lot to be desired. But maybe there was a lot embedded in that question, Jim. I'll turn it over to Jake and Sean as well.
Well, on the question about securities, that is a question that should be directed to legal folks. I'm not a lawyer. I don't know if Jeremy or Sean, you guys have any experience in that space, but I would say, just as a layman's analysis, and again, don't take this as legal advice of any sort, I suspect that fractionalization probably wouldn't ideally be a security. I think if you applied the Howey test, you might fail the common enterprise prong, or you might fail the efforts of others prong. But again, probably up to the courts on that one. And then I'm not sure I fully kind of got the second part of your question, Jim. Do you mind just restating it?
Well, the other one was just on what constitutes, value in an NFT versus people just dumping things with an NFT label. And I was giving an example of a musician who said, look, I'm on iTunes right now, but I'd like to have an NFT because they're hot. And to me, that doesn't mean anything.
Yeah, that's a good point. I was watching the Kings of Leon NFT tokenization the other day, and it's one, like, they probably had a bit of a design space, right, of what they could do with an NFT. And so what they chose to do was to say, like, okay, having this NFT is like denoting ownership in the album, the music files, I guess. And that to me could be an interesting case, but it's probably like a lot weaker, at least conceptually, from saying everyone who buys this NFT is entitled to part of the revenue stream of all the album sales. That is a much more disruptive structure, in my opinion, because then it like aligns all these people to essentially promote the album and like benefit from their promotion. And it's really a much stronger alignment of incentives. And then
Jake, I agree with you, but then you're getting into the security issue, which is what the other part of what I was saying. That's exactly sort of the complexity you get into.
Well, I feel like we should solve and explore these problems conceptually first, and then when we get to implementation, that's when we need to worry about jurisdictional kind of securities laws, and also these securities laws apply to the United States, and blockchain is a global technology. There are many jurisdictions where such schemes would be possible.
Clearly, we're in a world where, I mean, just the velocity of experimentation and innovation around this is incredible and is global, and it just, these things do persist and exist around the world. Things will be, certainly raised and challenged legally, but I feel like the experimentation is absolutely worth it. And I mean, this is just a space where, securities laws are just frankly incredibly outdated. They never contemplated these things, and we'll have to catch up. But the answer isn't just to slam existing 1933, 1940 securities laws on this. It's really to, ultimately, as I've said many times publicly in the past, we need a new definition of what a digital asset is,
right,
and what the interactions of it are. And that should be a policy goal for the United States. And that should be a policy goal for everyone. Yeah.
And I was just going to add, that's absolutely right, Jeremy. And I was going to add that when these experiments are performed, they create the basis for, and the examples of how to, make adjustments to those laws. So they're very necessary experiments.
Yeah.
I mean, even if they are performed like outside of the United States.
Yeah, no, absolutely. Well, look, listen, we're at a little bit over 9 o'clock.
Just on one thing real quick, Jared. Just say on the second part of the question. I won't at all try to go into the Howey test stuff, but just on the content question, I mean, I think there's going to be a lot of crap, honestly, that is out there, and that's okay. I mean, that's also true in a lot of other marketplaces, music and otherwise. The experiments are helpful to, weed through the crap, but ultimately work on product experiences, even if they may infringe on sort of untested waters with things like these securities issues. They need to happen. I mean, even things like bits and subs in Twitch have run afoul of discussions around what really are these bits that are in custom emoji that are being sent to streamers. But the experiments and product experiences will continue to iterate, and a lot of the content will look like crap, and the best stuff will rise to the top, but it'll also splinter into meaningful communities that don't have to be based on millions and millions of devotees to one specific gatekeeper, but can be much more evenly distributed than we've seen in the past.
Yeah, totally. Awesome. Sean and Jake, this is a really fun conversation. Everyone who joined us tonight, this evening, the morning, whatever it is for you, thanks for joining here in the Money Movement Club and with this session. And Jake and Sean, look forward to keeping the conversations going. And thanks again for coming out tonight.
Awesome. Thanks, Jeremy, for having me. And you guys keep up the great work educating about NFTs.
Absolutely. We got a lot more coming. Awesome. All right. Cheers, you guys.
Thank you.
Bye-bye.